Prior to June 1st, 2015, company law in Ireland spanned over 30 separate pieces of legislation. The new Companies Act 2014 simplifies and consolidates that law into one single act. One of the main innovations of the new Companies Act is its structure. It places the most commonly used vehicle, being the private company limited by shares, at the forefront of the legislation, where previously the focus was on the PLC. Arguably the biggest change under the new Act is the obligation for existing private limited companies to convert to a new company type. That would be either a private company limited by shares known as an LTD or a designated activity company known as a DAC. Alternatively, they can convert to another company type under the Act. While there are a lot of similarities between the LTD and the DAC under the new Act, there are some key differences. The LTD will no longer have a two-document constitution and instead will have just one document. The DAC will continue to have a two-document constitution, being its memorandum and articles of association. The LTD will no longer have an objects clause and therefore will have unlimited corporate capacity, whereas the DAC will continue to have its objects clause and therefore will be restricted in its corporate capacity. The LTD will be able to have just one director, whereas the DAC must have at least two directors. From June 1st, 2015, there is an 18-month transition period for companies to convert under the new Act. Companies and their directors should use this period to assess which company type best suits their needs. We recommend that directors and their companies proactively deal with the conversion process to avoid any company law sanctions and disputes. But for the first time in Irish law, directors' duties have been codified under the new 2014 Act. This is a welcome change in the area. It provides clarity and it follows the approach taken in the UK. Yes, the new Act deals with directors' compliance statements, and the obligation to prepare one depends on the company type and the company size. For example, all PLCs, regardless of size, must prepare a compliance statement, with the exception of certain investment companies. Other company types, where their balance sheet exceeds €12.5 million and their turnover exceeds €25 million, must prepare a compliance statement. The law on directors' loans has changed quite substantially under the new Act. For example, where a director loans money to a company and that loan is not properly documented, there is a rebuttable presumption that no loan was in fact made and it was effectively a gift. This is an entirely new piece of law under the new Act that was not previously legislated for. Generally speaking, the new Act removes certain roadblocks that existed under the previous legislation and presents opportunities for reorganisations and other corporate transactions. For the first time, two Irish private limited companies can merge. Another notable impact is the introduction of the summary approval procedure. It makes a number of processes easier under company law, including the ability to unlock pre-acquisition profits. The Act introduces a new system for the registration and priority of charges. The new rules state that priority of security is determined by the filing date of the security at the company's registration office and not the date of the security deed, as was previously the case. Overall, the changes should create more certainty in lending and security transactions. The new Companies Act is great for business. With the various innovations introduced in the Act, such as the new streamlined structure, one director companies and the removal of various barriers on corporate transactions, practitioners and businesses alike should see the benefits of the Act in the years to come.